According to Goldman Sachs Prime Book U.S. equity trading flow data for institutions, mostly hedge funds, there was a lot of trading activities in the week ending in ending on September 13th. And in this chart, we are seeing that in terms of total trading flow, including both the long position over here and the short position in this chart, we are seeing a lot of flow, okay, combined. As you can see, this bar here and this bar here represent the shorting. If you combine those flow together, it's the largest flow by institutional traders since March of 2023, or it's at 98th percentile in the past 5 years. The activity is led by single stocks instead of macro products such as index ETFs. And comparing single stocks versus macro products, single stocks were net bought for second week. It's plus 0.5 standard deviation above the 1 year average. And for the single stocks, financials, consumer, discretionaries, healthcare, communication services, and industrials were the most net bought sectors for single stocks. While real estate, consumer staples, information technology, and utilities were the most net sold. So it seems like this, in terms of single stocks, cyclical sectors were being bought. On the other hand, for the macro products, such as index and ETFs, they were net sold for the second straight week at minus 0.5 standard deviation below 1 year average. This is led by shorting of large cap equities and small cap equities and healthcare and consumer staples ETF. Overall, even though the fund has been actively deployed for the week ending in September 13th, but overall net flow for U.S. equity is still negative. Okay, it's the fifth straight week of negative net flow, but not by much. Not like a crazy selling, but net speaking, it's still negative. Overall, it's minus 0.2 standard deviation below the 1 year average. In this chart, you can see the U.S. equity aggregate institutional net flow since January of 2022. It's very interesting to observe two lines in this chart. One is the red hedge fund net flow, and the black dash line here, SPX price, or the S&P 500 price. It's very interesting to look at the correlation between the two lines, right? Because one line represents the price, the other line represents the smart money flow, okay? And it's very interesting to see that. I drew here a blue vertical line here prior to this date, which is 2023 November. Prior to that, the S&P 500 and the hedge fund flow they move in the same direction, okay? They correlate pretty well. But after the blue line here, after November 2023, they are going in the opposite direction. As you can see, the hedge funds are going downwards, okay? And the black SPX is going upwards. There is a diverging movement between the two lines. And this divergence could indicate that the hedge funds are becoming more and more cautious and bearish despite the rising market. Because if they're bullish, they will be buying when the market is going higher. So they might be expecting or speculating a potential market correction or increased volatility in the near future. On the other hand, we can observe that the money market fund, where the money is safe, it's like savings account in the banks, but they pay more over here, and that's where hedge funds, they park their money, even including the retail investors. The money market fund last week added $23.4 billion, and the total asset under management for money market fund is at a new record high of $6.324 trillion. Okay, so we're seeing the money is quickly flowing into money market fund despite rising stock market again, right? The rising stock market should cause FOMO, but people are not doing the FOMO stuff, right? The money is also going into money market fund. It seems like investors are hedging against potential downturns and again, increased volatilities in the near future. And according to Bank of America, Michael Harnett, their chief U.S. Equity strategist, he mentioned three things in his latest research report. Okay, number one is bullish bond. Okay, bullish bond. As more and more people, I think, believe inflation is behind us, and as he noted in his research, he said the hard landing risks are being underpriced. Right? If you look at what happened here in 2019, okay, this is 10-year bond yield, right? It's going downwards because people were expecting volatility. Because in 2019, the interest rate was raised to 2.5. People were scared. 2.5 is a lot for us. But of course, we're a lot higher now because we had inflation. But back in the days, 2.5 was a lot. People were scared. People were buying bonds, 10-year treasury bonds, causing the yield to go lower because people were expecting maybe there's volatility. Maybe the Federal Reserve will be forced to cut rate. Okay, and right now we're still kind of high according to Michael Harnett. Right, we're at 3.65% for 10-year treasury yield, and apparently, as you can see, right, it's going downwards. And they are at Bank of America, they're bullish bonds. They think the yield gonna go lower. They think it's heading towards 3% for the 10-year treasury yield. The second thing Michael Harnett noticed and he's bullish on is he's bullish on gold because the U.S. government debt and deficit trajectory, of course, is going higher. The government debt was $2.1 trillion, or 7.1% of the U.S. GDP in the past 12 months, right? Because, of course, the war and stuff, right? So, and he think it doesn't matter which party wins at the end, the large deficit will continue and the trajectory will continue. And also, I think why is this the case? Why is deficit driving people to buy gold? Because I think the more the more unsustainable the thing becomes, the more debt the government has, is possibly going to drive the fear for the market that the central bank will be forced to print more money again, because the more they borrow, the more they have to borrow in the future. And just to service what they have already borrowed. And where do they get the money? Through the money printer. And how do they get the money through the money printer? Through QE of the Federal Reserve. And when the QE, what's going to happen? It's going to drive the long-term inflation higher, devalue the dollar, right? And the more you print, the more destabilized your international currency becomes, or the world currency becomes, and people are just going to buy more gold. And Michael think that's the most driving force of the gold. But I personally think also, of course, there is the dollar being weaker. Why is dollar weaker? Because of the first point I mentioned, because of the 10-year treasury yield going lower. That means the long-term interest rate is going lower, which means it's going to be cheaper for the foreigners to buy gold because gold is priced in the US dollar. Okay, and the third thing Michael Harnett he observed is that he believed is that the market breadth is getting wider and wider, meaning that back in the days, or I guess for the past year, we were driven by the Magnificent Seven, right? The seven largest stocks, the tech stocks, the giants. And now it's broadening out, especially we see the NVIDIA getting corrections, right? And the money is flowing into other stocks, other sectors. Everything is participating in this market rally. And Michael Harnett also identified that there are a lot of potential tail risks in the future, in the near future. The tail risks are either positive or negative, right? There is tail risks such as AI bubble, Russia-Ukraine peace talk, China policy, and there's falling payrolls. There could be surging delinquency rate, right? All of a sudden, lots of people are going bankrupt because of whatever reasons, no low savings rate, or just people run out of money because of high borrowing costs for too long, right? There's a wide range of possibilities or potential outcomes in the future, volatilities in the future. Both can be positive or can be negative, and he's advocating for a volatile mixture of opportunities and risks for the next 6 to 9 months. Hey, if you think this kind of a hedge fund insight or I guess institutional insights are very helpful, I upload this kind of video frequently. Just like and subscribe to the channel, and I'll see you more. Thank you. Bye.